We want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Chinese regulators are said to be taking some of the most extreme measures yet to cool a bond market rally. Sources say commercial banks in Jiangxi province have been told not to settle their purchases of government debt. China correspondent Min Lo joins us now in Hong Kong. So, Min, we've heard these warnings coming from authorities for a while now. So how significant are these measures?
Yeah, it is part of a slew of different measures that are now working in tandem to arrest that bond rally that we are seeing. And some of the measures have been working because yesterday you saw that 10-year bond yield going up 4 basis points to 2.24%. That is the highest we've seen in 3 weeks. And so yesterday there are these several rural banks that have failed to settle their transactions after authorities told them to stop buying bonds. And some analysts are saying that this is quite an extreme measure because reneging on bond transactions could undermine market stability if the counterparties then start to expect or worry about more failed transactions in the future. And we also understand that these Jiangxi authorities had initially rescinded that order before reinstating them, which suggests that even the officials are also struggling to, find the right balance here as they try to inject market stability while, preventing this bull run in the market. And at the same time, we understand from at least 4 brokerages that they are cutting down on sovereign bond trading. Most of them are saying it's a voluntary move, although at least one is saying that they are following guidance from the authorities as well. And yesterday as well, the state banks continued to sell 100 million yuan batches of the 7-year bonds. And you have authorities also being slow to approve new bond funds as well. So a number of measures are working together at the same time to help to lift those bond yields.
Foreign investors have pulled a record amount of money out of China over the last quarter, and perhaps unsurprising given a lot of the downward sentiment and concerns over transparency and policymaking.
Yeah, that's right. So it reflects a bit of that pessimism in the economy. Foreign investors taking out $15 billion from the Chinese economy in the second quarter. And that's only the second time that we've seen that number turn negative. In the first half of the year, it was down $5 billion. And if this trend continues, this will be the first year we would see an annual net outflow of investment from China. And there are a number of factors at play here. You have the geopolitical risk that could be causing some companies to cut exposure to China. You have the weak domestic economy as well, and China's surprise advancement in areas like EVs, for example, is also causing some companies to scale back investment in China. And at the same time, on the flip side, you have the domestic Chinese companies sending record amounts of money abroad as well, over $71 billion in the second quarter, up 80% from the previous, from the same period last year as well. Again, reflecting, the need to find new markets overseas outside of China.
With China correspondent Min Lo there. It's time now for morning calls ahead of the Asia trading day. Goldman Sachs trading desk sees a brief window for investors to buy the dip in U.S. stocks. Tactical specialist Scott Robner says he's turning bullish on U.S. equities at the end of the month as selling pressure from systematic funds eases. Morgan Stanley now says a double whammy of economic uncertainty and a weak period for corporate earnings forecasts is likely to cap stock market gains in the third quarter. Strategist Michael Wilson expects the S&P 500 to trade in a range of 5,000 to 5,400 points as macroeconomic data flash no clear signs over the short term. We have more to come. This is Bloomberg.